Have you ever wondered if the financial advice you're getting is really in your best interest? Or if there's maybe something else going on behind the scenes? Well, it's a huge question, and it gets right to the heart of how our financial system works. Today, we're going to dive into what happens when your banker has to wear two very different hats. You know, the whole issue really boils down to this simple but pretty powerful idea: the problem of wearing two hats. Just imagine your advisor is trying to serve two masters at the same time. On one hand, there's you, the client, and on the other, their own bottom line. The conflict kicks in when what's best for them isn't what's best for you. So what are we actually talking about here? A conflict of interest is any situation where an advisor's own interests are competing with their duty to their clients. It's a fundamental clash. It's when their own wallet is pulling them in one direction, but their legal obligation, their duty to you, is pulling them in another. All right, Section 1, the banker's two hats. To really get how this all works, we need to dig into this core concept of divided loyalty. Let's take a look at where this whole problem even came from. What's pretty wild is that banking didn't start out this way. I mean, the original idea of merchant banking way back in medieval Italy was actually pretty simple. You had entrepreneurs funding other entrepreneurs. It was all based on relationships and trust. But fast forward to today, and we're in this massive, tangled, global system where honestly potential conflicts are baked right into the structure itself. So, with everything being so complex, how can anyone possibly spot a potential conflict? Well, there's a great little rule of thumb for this. Just follow the money. Seriously, ask yourself, how does my advisor or my bank actually make a profit from this deal? The answer usually tells you everything you need to know about where their real priorities might be. Okay, Section 2, following the money in M&A. Let's make this real. We're going to follow the money in one of the highest stakes games in all of finance, mergers and acquisitions, M&A. Think about it like this. In any big M&A deal, you've got two opposing teams, and each has its own investment banker. The sell-side banker, their one and only job is to get the highest possible price for the company that's being sold. But the buy-side banker's job is the complete opposite, to get the absolute best deal for the company that's doing the buying. See? Two different hats, two totally opposing goals. So for the company that's up for sale, their banker is their champion. They're the ones building the hype, finding the buyers, running the auction, and fighting tooth and nail to squeeze every last dollar into that final price. Their entire duty is to the seller, period. Meanwhile, on the other side of the table, the buyer's banker is out there hunting for the right companies to buy, figuring out what they're actually worth, coming up with a smart bidding strategy, and even helping line up the cash for the purchase. Their loyalty is 100% with the buyer. And this brings us to the million-dollar question. What happens when those lines start to get blurry? What if one big firm is trying to advise both the buyer and the seller? Or what if a bank that's advising a client to buy a company also happens to have its own money invested in that company? This is where the risk of conflict just explodes, and it's exactly why we need rules. Which leads us right into Section 3, the official rulebook. Let's talk about the solution that was created to manage these exact problems. So in the U.S., one of the key regulators is the Office of the Comptroller of the Currency, or the OCC. And they've put together this incredibly detailed handbook that is, for all intents and purposes, the official rulebook for how banks have to deal with conflicts of interest. It's the government's answer to the two hats problem. So what's the point of all this paper? Well, the goals are pretty straightforward. It's all about preventing banks from enriching themselves at their clients' expense. That's called self-dealing. It's about making sure things are fair, stopping insider trading, and at the end of the day, making sure the bank is always acting in the client's best interest. Section 4, managing the risk. Because look, having a rule book sitting on a shelf isn't enough, right? The banks themselves are required to build systems to manage this risk from the inside out. The OCC lays out a pretty clear 5-step game plan. It all starts at the very top. The board of directors is ultimately responsible. From there, banks have to create crystal clear written policies and a code of ethics. Then, they need systems to actively find and deal with conflicts. They also have to train their people on all the rules. And finally, they need things like audits to make sure everybody is actually following them. All right, Section 5, an unintended consequence. So, we have a problem, conflicts of interest, and we have a solution, this huge rule book. Story over, right? Well, not so fast. It turns out the solution might have created a brand new problem. And this is the real twist in the story.
Is it possible that these extensive, well-intentioned rules, the ones designed to make the whole system safer, could actually have negative side effects for the very economy they're supposed to be supporting?
Let's just look at the data. After the 2008 financial crisis, the U.S. passed the Dodd-Frank Act, this enormous piece of legislation meant to make banking safer. But check out this chart. It shows a pretty startling side effect. After these new rules went into effect, the slice of the pie for business loans going to small businesses just plummeted. Let's put a fine point on it. One study found that the new regulations were directly responsible for an 8.6 percentage point drop in the share of loans going to small businesses. I mean, that is a huge shift in capital away from Main Street. So the big question is why? Why did this happen? Well, the study concluded that the new rules, with all their new compliance costs, basically increased the fixed cost of making any loan. Now, for a giant corporate loan, that extra cost is a drop in the bucket. But for a small loan to a local business, that same fixed cost can make the whole loan unprofitable for the bank. It essentially priced small businesses right out of the market. And that leaves us with this final, really critical question. We obviously need rules to prevent the two hats problem and to protect clients. But if those same rules make it harder for small businesses to get the money they need to grow, what's the right balance? That's the tightrope regulators and bankers are walking today, and there are absolutely no easy answers.